Hi, Jim Kruzan here with another capital market review. This time we're dealing with the third quarter of 2020 as of September 30th. Wow, what a crazy quarter and crazy year. Things were looking very promising as we began the year. With the trade treaties that were just signed, the expectation was the economy was actually going to grow. And then COVID hit. And the stay-in-place orders caused a horribly deep recession. Markets started to rebound almost immediately from the bottom because of some government intervention and support. And that continued as the economy started to show some signs of improvement as well. That all happened during the summer months. And here we are today, with the market having almost a perfect V-shaped recovery. And yet the economy, well, that's still a bit questionable as to what letter of the alphabet that's going to look like. At this point, looks a little bit more like an L, as we are still with nearly 8% unemployment, and we are still about 8% lower in terms of GDP than we were at the beginning of the year. It really has been something. And if COVID isn't bad enough, we're now entering the political season, and a lot of concern over politics and policy and the effects it may have on our markets and the economy as well. We're going to touch on a lot of these points during this fairly short capital market review. But first, our disclosure statement. For those who would like to read it, terrific. Otherwise, let me just shorten it up. I am solely responsible for this content. I'm responsible for the slides, and I'm responsible for any word uttered in this presentation. So there. As we do every quarter, we come up with a theme, something that would encapsulate our surrounds. And Danielle Howard on our team came up with this. She said, let's get some clarity. We could probably also just say, searching for clarity, because really, truly, we have none. Yes, the markets are up, but without clear understanding of what happens next with the economy. And we won't know what happens next with the economy until we know what happens next with COVID. And unfortunately, nobody has a really good understanding of what that's all about. We do these sessions because we believe the economy matters. And as we try to dissect major components of the economy, corporate growth rates, jobs, profit, inflation rates, and also interest rates. And the reason we do that is it really matters. At the end of the day, economic growth or weakness has an effect on corporate profits and also has an effect on stock markets. We try to attempt to answer two important questions: where we are and where we're heading. And when it comes to allocating assets, especially those within the IRAs that we're a bit more tactical with, we try to understand where we are in terms of the economic cycle and also where the Fed is currently. As far as the economy goes, we would have to say that we're starting the recovery phase. By definition, a recession is 2 negative quarters in a row. We had that in the first quarter and the second. The third quarter, we had measured economic recovery, both in terms of output and GDP. So we would have to say that we're through the recession and now we're starting the recovery, but still we're far from fully recovering. And as we'll learn in a few minutes, the full recovery may take quite a while longer. And where the Fed is, that's an easy one. They are in full strength accommodation. They are loosening, they are accommodative between the money that they're throwing at the economy in terms of fiscal and monetary policy, the CARES Act, PPP loans, unemployment, etc., they're making sure that there's plenty of liquidity out there. So we won't have the same problems that we had during the financial crisis. And they cut interest rates too, as we'll see in a few moments, to unheard of levels. Today's agenda is fairly short. We're going to cover 4 areas. We'll talk for a few seconds about the pandemic, kind of where we are. We'll talk about the economic recovery and what the growth prospects look like. We'll talk about this fiscal and monetary policy and the amount of money that's been thrown at the problem. And then we'll talk a bit about stocks in terms of valuation and why, at the end of the day, diversification is always a safety valve, is always one way of reducing some degree of market risk. So let's get right into the pandemic. This chart certainly does not show the kind of grief or pain that the pandemic has caused people around the world. With over 1 million dead worldwide and over 200,000 dead in the United States, it's hard to show that on a graph. This graph, however, will give us an idea of the general trends of the coronavirus and what's happening both in terms of cases as well as death rates. This, by the way, is a 7-day moving average. So it gives us an idea of rate of change and momentum. The blue line represents confirmed cases. The gray line represents fatalities. And you can see as we move left to right and move to history to current, we see that the death rate, the gray line, has been trending for several months now lower. That slope is negative. As we move left to right, it's descending, and that's a plus. The expectation is at the end, we should see death rate hovering around maybe 0.5%, maybe a little bit less. Confirmed cases has started to rise again and has been rising since early September and rose spectacularly in the early summer. Remember those pictures of boaters on Torch Lake and other places, a lot of people congregating very close together without a lot of masks. And we're seeing it again now. Maybe people feeling a little complacent, or maybe the cooler weather, but we're beginning to see some increase in confirmed cases. Now, some of that might very well be just the fact that there's a lot more testing going on. I heard from somewhere that right now it's expected that there's probably 200,000 people running around the U.S. that are positive on COVID, have no idea they're positive on COVID, and have asymptomatic symptoms. So they're perfectly healthy, but they continue to spread the virus through our economy. We're beginning to see a bit of a recovery, but we've got a long way to go. This will give us an idea of GDP growth and the lack of growth that we've seen this past year. So what we're going to look at is everything to the left, the left half of the page. And you'll see these kind of clumpy looking gray symbols. Those are yearly GDP growth rates. The hash mark across the horizon, averaging 2.5%, is average growth going all the way back 50 years to 1970. And you can see that to a large degree, we have a hard time growing much above 2.5%. Oh, there have been periods of time, the early 80s, with the advent of desktop computers or tablets. You'll see periods of time with spikes in GDP growth because of productivity. But we really haven't seen that of late. And at the very end, if we move left to right, you'll see this large drop, certainly overshadowing any other drop we've had. That was the drop that we saw year over year in GDP because of COVID and the stay in place orders. That drop was almost 31%. And on a year over year basis, it was better than 9%. Now let's put that in perspective for a minute. During the financial crisis, as bad as it was, with a nearly 60% drop in the S&P, our economy shrunk by a little over 4%. And here we shrunk by 9. We're coming back a bit, but even today, our economy is nearly 8% weaker than it was a year ago. So it's going to take some time to dig out of this. We saw a huge spike in unemployment, and then we've seen a fairly rapid recovery. On the left hand of the page, we see the employment numbers. Strong employment from 2010 right up through 2019. Leveling off at about 3.5% unemployment, and then the significant drop, 22 million jobs lost. And then almost on top of it is the parabolic move up. Wouldn't even call it a V. It's almost a straight retracement of the line going down. We regained about 10 million of those jobs. Not quite, but almost half. It is now expected that the second phase of job recovery will be slower and a bit more muted, because the jobs that still have to come back, as you see on the right-hand side, are many of those jobs that are involved in consumer discretionary spending, hospitality and leisure, etc. It's an interesting chart because it shows the total number of jobs lost and also the percentage of jobs regained. One interesting point is on the far right, mining and logging, in particular logging. That negative number implies not employment lost, but jobs gained. So when we look at that, you'll see that in the logging industry, there's huge help wanted ads. I think Mrs. Kruzan probably has something to do with that. Every day out of the air, we have brown cardboard boxes that get replaced just about every night on our stoop. And there are some trees that have to be harvested somewhere to produce that cardboard content. So it's interesting to see that we're at least supporting one industry out there. Corporate profits fell pretty dramatically, and it's going to take a while for those to come back. Now, if we look at the blue lines, the vertical lines to the right, and you walk back to the fourth line, which is, I don't know what color that is, purple, I guess. That was last year. 2019 was a better year than 2018, which was a better year than 2017. 2020, sizable drop. In fact, corporate earnings have been reset about 3 years. You'd have to go back to almost 3 years to see what those numbers look like. And it looks like it could be well into 2021 before earnings come back to where they were in 2019. And it might be late in 2021. So the expectation year over year is actually some fairly robust earnings growth going out this upcoming year. But from a valuation point of view, as you'll see in a few minutes, markets are somewhat expensive. If valuations of stocks are about where they were at the beginning of the year, because markets are up or slightly flat or slightly up, but we have an economy that's still about 8% weaker than it was in January, then those prices relative to economic growth possibilities are pricier and more expensive. Let's talk about the Feds and fiscal and monetary policy. And we really want to start with inflation because there's a major shift in the way the Fed looks at inflation. First off, the inflation rate is really quite low. If we look at the inflation rate as it relates to the blue line, so what we're talking about now is actually the gray line. You'll see a little bit of a dip and then a little bit of a recovery, meaning we're seeing a little bit more inflation in the system today than we did before. Those bars that you see across the page running vertically represent recessions. And if you look to the far right, you'll see a very, very thin vertical line that would be the recession that we just went through as a result of COVID. We were actually out of it before theoretically they could even calculate we were even in one. A very short but extremely steep recession. If we look inside the box, which talks about CPI numbers, price inflation numbers, you'll see why inflation is relatively low. Look to the far right, and you'll see August, that's the last recorded month. And if you look down 3-4 line items, you'll see energy CPI. That's energy, inflation-related energy. And you'll see it's a minus 9.1%. That's a huge offset number to the rest of inflation. Inflation is held down because of what's happening in the energy fields. Food has spiked. Inflation as a result of food has certainly gone up. And inflation in other areas have as well. I've got a client I talked to just recently who was planning on building a pole barn up north in their retirement home. And he elected to wait. He's pouring the foundation, but they're not actually going to build until next spring. And the reason is lumber prices, OSB board prices, etc., have gone up substantially because of this home building, because of low mortgage rates. And he's hoping that maybe prices will normalize sometime next year. But if you look at the core CPE number, which is the bottom line, you'll see we're at now at about 1.6, up from 1.4, still well under average. So here's why we think inflation may very well be a little bit of a problem. The government has thrown about $8 trillion at the COVID problem, either in terms of direct payment or increasing their balance sheet. At some point, we will have a vaccine. At some point, the economy does open. And that can actually serve as quite an accelerant. So we could see fairly aggressive GDP growth, at least for a while. The other thing that happened in August is the Fed changed the way they calculate inflation, or I should say, changed the way they react to inflation. Before, anytime that core number, which is at 1.6, would get above 2, they would look at starting to restrict. Maybe increase the discount rate, maybe slow down the Fed funds available through the banking system. And that would generally moderate the economic growth. Now they're going to a rolling average. They're averaging several years in a row. So the last several years, the rate has been very, very low. In fact, in a couple of years, it was actually sub 1%. In fact, there were 3 years in the last decade where Social Security didn't have a single cost of living adjustment. So by going to an average, it's going to allow the current inflation rate to rise certainly comfortably above 2 before they take action, because as they average it out, it may still very well be under 2. So this is a very difficult balancing act. And based on prior Fed performance, they usually get it wrong. By the time they react, we've got some rampant inflation. That might also be one of the reasons that you're seeing gold prices have a really pretty good year this year, considering it tends to be a safe haven for those worried about inflation. Interest rates are going to stay low for a very long period of time. You can see what the Fed funds rate looks like. They dropped the rate to 0 to 25 basis points, which is about as low as it can go before it goes into negative territory. And Chairman Powell has been adamant about not taking interest rates in the U.S. into the negative area. This chart inside the box will give you an idea of where they see economic growth. We might see GDP growth of 4% next year, and then leveling back off to something longer term trend at about 1.9. The unemployment rate may get to sub 8 by the end of this year, but then look at how more slowly it will move. So if it gets to 7.6 at the end of this year, that's down from 14. That was a 7% move this year. Next year, maybe a 2% move. The year after, maybe a 1% move. So it's going to be much slower bringing those jobs back. And as far as the inflation rate, creeping up ever so slowly now because of this average best fit that they're using. This is a busy slide. I'm going to take you kind of around clockwise from the very bottom on the left. CBO, that's the Congressional Budget Office, that's Congress's accountant. They put together a lot of figures and facts, and they kind of vet out costs of certain legislative actions. Real GDP growth will be minus 4-ish this year, all in, and then about 2.5 over the course of the next 2 years on average. These are CBO's numbers, which are independent from the Fed's numbers that we saw on the prior page. Treasuries are not expected to move a whole lot the next 4 or 5 years. Headline inflation, not a whole lot the next couple, and then start to move a bit higher above 2. And the unemployment rate, again, very slowly descending. Everything on the right-hand side of the page has to do with the deficit. That would be the yearly amount of overspend versus intake. And then at the bottom, the national debt, which is the aggregate or the accumulation of all those deficits. What's really important is we've really blown the budget this year because of all the government spend. Last year, we ran a deficit. Heck, we've run deficits for many, many, many years. In fact, looking at that chart on the right, at the top, you'll see the years of the dot-com bubble or leading into it, we actually ran a surplus. And that was because a lot of these companies were going public. People were making a lot of money on nonsensical companies, paying a lot of taxes because of the ordinary taxable income rates on these IPOs. And we had more money coming in than what we spent. But the last many decades, we've been running a deficit, spending more. Our deficit was about 4.6% last year. It's 16% this year, which means starting next year, our national debt, you'll see that at the bottom chart on the right, our national debt at the end of this year will actually be over 100% of our GDP. And it's expected to continue to grow over the course of this decade, finishing up at almost 110% of GDP. That's not a good trend. It's not overly problematic right now, but it is problematic over the long term because a lot more of our productive resources will now be used to cover debt service as opposed to reinvest back in the economy. Now, there are some things that can be done. Congress can declare and allow the Treasury to issue, let's say, 50-year bonds, and we issue those out at really horribly low rates, and that allows us to pay that debt very slowly, and then we can refi some of the higher yielding debt with this very low long-term debt. Disney, other corporations do it all the time. There are a number of large corporations that have floated successfully 100-year bonds. So there's no reason not to take advantage of that. And that would help provide some breathing room. It would help reduce the amount of our GDP that needs to be used for debt service. I know there's a lot of angst surrounding the upcoming presidential election. The presidential election, the Senate, SCOTUS, public protesting, all the other things that are happening that can cause a lot of angst. This is an interesting chart because it talks both about the S&P 500 pricing and real GDP during various situations where one party or the other may have pure control or have a mixed divided government. In the bars that are red, that would be where the Republicans control the White House as well as Congress and the Senate. And the blue bars are where the Democrats control the White House, House, and Senate. The gray bars, which there are many more of, is where there's a divided government. whatever the iteration might be. And there really is no consistency in pattern. Can't say because of a change, things are progressively going to be worse or going to be better. There are great years with Democrats controlling and great years with Republicans controlling. And in many cases, better years where there's some mix. Dr. Kelly, who kind of runs the department that puts these slides together at JP Morgan, says, look, it's never a good idea to let your political biases kind of cloud your investment strategy. But I understand the concerns. Because of that, we're taking some of our equity down a bit, just because we think price valuations are high and there is some degree of uncertainty. We'd rather have some dry powder going into the election to be able to reassess where things are at that point in time and then reallocate appropriately. I think from a risk management perspective, that certainly seems to be a bit smarter than going in with a weighted average toward equity and then be right in the middle of what might be some consternation. What if we can't declare a president right away? What if we have an 8-person Supreme Court? What if it takes months before somebody is actually declared president? I'm sure that would affect consumer confidence, and that has a direct relationship to stock pricing. So in the long term, doesn't seem to make too much of a difference. In the short term, you can certainly see some degree of volatility. Let's look at interest rates for a second and inflation. So the blue line represents interest rates, and the gray line represents inflation-adjusted interest rates or real interest rates. In other words, the interest rate minus the inflation rate. And what's really interesting is today, look at the blue line, we have had nearly falling interest rates since 1981. When rates peaked September 30th. And now we have 10-year yields at 0.69% as of September 20th. Imagine that, locking money away and effectively earning 0.69%. 69 cents per $100 invested for 10 years. Unheard of. Also, more importantly, is when you look at the current inflation rate and you subtract that from the current yield, you're actually in negative territory. In other words, sitting on a lot of cash as an investment strategy, not as a holding place short term until we figure out where else to move it, but as a long-term investment strategy, does not make sense. You are not doing the one thing you need to do in retirement, which is stay ahead of inflation and preserve your spending ability. Moreover, if we assume what is being invested is taxable at some point, you're going to pay capital gains, you're going to pay ordinary taxable income, then the real net return after inflation and taxes is progressively lower still. So it's a market that generally is supporting higher stock prices because there's no other game in town. And that's really kind of the theme around the equity discussion we're going to have. Price valuations are high, any way you look at it. In fact, there's only one metric that would suggest they're not quite so high. But this is forward-looking PEs, and you kind of see where they're at. If you look at, if we start with the left and you see this mountain, the gray line moving up the mountain and then down, that mountain, that high watermark was the ridiculously high valuations that we saw during the run-up to the dot-com bubble burst. And then we saw the big drop, and then subsequently we've seen this recovery, meaning this rise in PEs. And now a huge spike in PE because we had this huge, very quick drop in earnings, PE, price to earnings. If earnings drop because of COVID, stay in place, and P's, price, are about where they were, if not a little bit higher, then the PE gets way out of whack. If you look at the chart inside there and look at where current PEs are, 21.5 times earnings, and compare that to a 25-year average of 16, it's high. If we seasonally adjusted the rates, it's the Shiller cap rate, that's CAPE, cyclically adjusted PE. So it's more of an average over time. The Shiller rate's 30 compared to 27, still high, but not as high as regular PE is. But look, the markets are high, they're expensive. But again, they seem to be the only game in town. Dividend yield is high relative to historic, meaning the yield is lower. So when you have a lower yield, you generally have higher stock prices. So the yield is 1.7 to an average of 2. Price to book at 3.5 means you're paying more money for every dollar of book value. That's more expensive. When you look at price to cash flow, which is a great tell of the financial health of a company, the long-term average is about $10 for every dollar of cash flow. We're now paying 15. The only thing that looks cheap is the EY spread, which is earnings yield spread. It's basically the inverse of the PE. So you do a reciprocal of the PE and you compare that to an investment grade bond. And right now there's a positive earnings yield of 1.24. You're getting paid more in yield as to earnings than you would yield off of bonds. That's really less to do with the fact that stocks are cheap. It has to do with bonds are really expensive and no place to go. International securities are cheaper. They're much cheaper than the US. International is down year to date. But when you look at it from a price to book ratio, price to earnings ratio, they're incredibly inexpensive. I was on a call earlier this week with an analyst from Morningstar, who is one of their global allocators. And she was mentioning some of their themes going forward. And what she mentioned coincides with just about every single econometric firm in the country. Over the next 10 years, the expectation is developed international as well as emerging markets will outperform the US market because of valuation, because of mean reversion, because of a weakness in the US dollar. We haven't seen it year to date. We expect it will happen. We can adjust accordingly. But right now, when you compare its valuations to the US, there's something to be said for you can buy more earnings cheaper, more book value cheaper, more cash flow cheaper. And at some point, that is reflected in performance. At the end of the day, what's the best strategy? Well, if you're lucky enough to be able to time the market, which nobody is, if you can make adjustments to market trend and hope the trend stays long enough that you can make a difference, that helps. Another thing is allocate, diversify. As this chart suggests, look, it's hard to pick winners. Things that do well one year might not do well the next, so on and so forth. But if you run a reasonably balanced portfolio throughout, you don't have nearly the same adjustments. You eliminate a lot of the feast, the famine, and you get returns that are a whole lot more consistent. And that's what we're trying to achieve. We're trying to improve your odds for a fuller retirement by implementing strategies like tax efficiency, etc., and also develop an investment portfolio and strategy that just doesn't blow itself up. All those things help to improve your odds for a fuller retirement. And with that, I'd like to thank you for participating in this quarter's call. I'd like to remind you, hey, we are open for business. And if you know anybody, friends, family, loved ones, somebody you care about, who might like to get a better idea of where they are, an idea of where they are from a retirement readiness perspective, we'd love the ability to do that. We run our clients through an evolutionary wealth process that starts with our discovery interview, where we get to know them better, get to know their goals, objectives, fears, what the resources look like. In our second meeting, clarity, we give them a really good idea of, through our eyes, where we think they are from a retirement readiness perspective, but also what an engagement, what working with us would look like. If there's some commonality and we want to move forward, we have that mutual commitment meeting, and then we start all the development completion meetings to develop the plan and start executing strategy. With that in mind, once again, I want to thank you. I'd like to hear from you. If you have any questions about anything I mentioned, comments, anything that we can do to improve our offerings, by all means, please reach out. You can do that by calling us at 810-593-1624, or simply shoot us an email at www.kaydanwealthmanagement.com. Visit our site. There's a place there where you can actually provide comment or ask questions. Thank you. Look forward to seeing you again real soon. And if not, we'll certainly talk again, chat again, right here for the next quarter. Be safe and healthy. Thanks.